Hello, this is Japanese Economic Review Channel. Today, we analyze Japan's June 2026 industrial production. The theme is a seesaw struggle. Production grew 1.3% for the third straight month, but shipments dipped 0.4% and inventories rose 2.3%. On the surface, this suggests passive stagnation. However, a deeper sector-level breakdown reveals robust machinery demand and strategic preparation for future expansion. Let's explore the key dynamics of production, shipments, and inventories. Let's look at the overall landscape. In June 2026, the seasonally adjusted production index stood at 103.9, up 1.3% month-on-month. Conversely, the shipments index fell slightly by 0.4% to 101.1. Consequently, inventories rose 2.3% to 97.1, pushing the inventory ratio up to 104.7. This pipeline imbalance seems like a passive buildup of unsold goods. Yet, as we decompose this inventory, we find a distinct duality between passive stagnation and strategic stockpiling. What drove the 1.3% production growth? This slide reveals the industrial tug-of-war. The primary engines were production machinery surging 7.6% and electrical machinery rising 5.8%. General-purpose machinery also grew 4.7%. However, these gains were partially offset by a 6.3% drop in electronic parts and devices. Despite this device correction, the overall production base remains resilient, heavily supported by B2B capital expenditure. Now let's examine the shipment drags. The aggregate shipments dropped 0.4% primarily due to the mobility sector. Stagnant ship deliveries dragged down transport equipment excluding autos by 20.3%, while autos slipped 4.4% on weak passenger car sales. On the bright side, production machinery shipments surged by 8.0%. This indicates that the shipment dip is not a systemic demand crash, but rather a temporary bottleneck in auto and ship deliveries. Inventories swelled by 2.3%, but this buildup has two distinct characters. Passively, motor vehicles grew 7.0% due to slow sales, representing involuntary stagnation. Actively, electrical machinery and devices grew 7.4%, driven by lithium-ion battery stockpiling. Manufacturers are strategically securing batteries to prepare for the green transition. Understanding this duality is crucial. Not all inventory growth is bad. Some is strategic preparation. This sector health matrix synthesizes production, shipment, and inventory data. Production machinery shows optimal health, where strong production matches high shipments, plus 8.0%. Conversely, autos exhibit severe bottleneck symptoms. Production remained slightly positive, plus 1.1%, yet shipments fell, minus 4.4%, and inventories swelled, plus 7.0%. This grid helps us prioritize where to address supply chain frictions and where to ride the growth wave. Let's zoom into the microstory of capital expenditure. Advanced tech and machinery demand remain bright spots. Capital spending drives output in semiconductor manufacturing equipment, notebook PCs, and measurement devices. While consumer markets fluctuate, the industrial upgrade cycle is providing a strong tailwind. This technology-driven investment is the core anchor preventing a broader manufacturing recession in Japan. To put June's data in context, we must visualize the long-term seesaw trend since early 2025. This slide charts mining and manufacturing production, iron and steel, general-purpose machinery, and fabricated metals. We see a clear undulating pattern across all sectors, validating the ministry's assessment of a fluctuating macro environment. June's performance is not an isolated event, but part of an ongoing cyclical adjustment. What about the near-term outlook? The Production Forecast Survey projects a 1.2% rise in July. Growth will be led by chemicals up 7.2%, driven by organic chemicals and plastics, and electronic devices up 4.3%. Meanwhile, electrical and infocom machinery is expected to fall by 2.2%. This July forecast indicates that the summer is off to a stable start, with key export sectors resuming their upward momentum. August forecasts point to a strong late summer expansion with a projected 4.5% surge. The growth will be heavily driven by production machinery, expected to jump a massive 11.2%, and electrical machinery rising 7.2%. While these plans are highly optimistic, they show manufacturers' confidence in a robust Q3 recovery. However, achieving this 4.5% surge requires realizing aggressive production plans. Finally, we must test the feasibility of these forecasts. In June, the overall realization ratio was minus 3.2%, and July's amendment ratio was minus 2.0%, showing a pattern of over-optimism. Crucially, The electronic devices sector missed targets by a staggering minus 16.9% in realization. Therefore, the key takeaway is caution. We must monitor actual realization and auto inventory digestion rather than taking the August plans at face value. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.